Hi, this is Tony Sagami. Hey, tell me if this sounds a little familiar to you. The Bank of Japan last week lowered their key lending rates from 0.1%, just 0.1%, to a range of 0 to 0.1%. Yes, 0 to 0.1, essentially a zero interest rate environment. The Japanese equivalent of our Federal Reserve Bank is attempting to send a message that's going to maintain its accommodative monetary policy in hopes of stimulating the very sluggish Japanese economy. Now look, Japan has been maintaining this essentially zero interest rate policy since 1999, and it hasn't worked at all in the last 10 years, and there's no reason that this largely symbolic move is going to have any meaningful impact in Japan either. No, and just like Ben Bernanke and his Fed buddies, the Bank of Japan has essentially shot all their monetary bullets, and they've painted themselves into a very desperate corner. How desperate? Well, let me tell you what they're going to do. It's similar to what we're seeing in the U.S. Japan is setting up a $60 billion fund to buy toxic debt of corporate bonds and even REITs, real estate, and even Japanese stocks in hopes of jump-starting the stagnant real estate and stock markets. This new program, they're calling it comprehensive easing. Sound familiar? Well, this is defined as a combination of quantitative easing, which we're doing here, which is bond purchases designed to pump liquidity into the economy, and credit easing. And this is direct asset purchase of Japanese stocks and Japanese bonds, real estate. And so in some way, what you saw, that big rally last week on Tuesday, was that Wall Street is hoping that the Federal Reserve Bank, Ben Bernanke and his buddies, will follow the Japanese example and start doing that with some money, buying U.S. stocks and U.S. real estates. These wishful thinkers would do well to understand how badly the government intervention worked for the Japanese stock market. Again, let me tell you some specifics. The Japanese stock market peaked at 37,000 and change back in 1988, and today it's around 10,000. Can you imagine investing in the stock market for 22 years and still being 70% underwater? That's how pathetic the Japanese stock market has been, and this is the government model that they hope the U.S. Wants to copy. Now, I've got to tell you, this is going to get worse for Japan, because now with the yen sitting at 83 per U.S. dollar, a strong currency is murder for a heavy export-dependent country like Japan. And to give you an idea of how much things have changed, the last time I was in Japan was back in late 2007, and then I was getting about 110 yen per dollar. So now it's down to 83. And what makes me definitely afraid, is the next time I go to Tokyo, I can't imagine how much a hotel room is going to cost me then, because of the currency translation. But there are some more important things that you should keep in mind as an investor. Number one, you need to stay far, far away from the big Japanese exporters like Canon, Honda, and Sony. If you own them, sell them, because they're going much lower. Now, on the other hand, this new $60 billion bailout is going to help some companies, specifically the Japanese banks and financial services. There's 3 of them that are listed here on the New York Stock Exchange that I think that you could take a look at. One would be Mitsubishi Financial, and that ticker symbol is MTU. Mizuho Financial, MFG, ticker MFG. And perhaps the best one, in my opinion, is a company called Orix, O-R-I-X, and its ticker symbol is IX. Now, if you're a baseball fan, that might sound a little familiar to you, because that Orix Blue Wave is who Seattle Mariner Ichiro Suzuki used to play for. But enough about trivia. Take a look at the Japanese financials. They popped real big on that news. But these are big beneficiaries of this government stimulus plan. And like the TARP money, there's going to be some big windfalls by investing in the right Japanese banks. Until next week, this is Tony Sagami signing off.